Hello and welcome everybody to another episode of Books and Bytes. Today we're taking a deep dive into Javier Milei's compelling work, El fin de l'inflation, or in English, The End of Inflation. This book, and it also features contributions from other leading economists, tackles one of the most persistent and, well, destructive economic issues faced by many nations, particularly Argentina: chronic inflation. The book lays out a very clear argument right from the start. It states that inflation is, always and everywhere a monetary phenomenon caused primarily by excessive money creation by central banks.
Right.
It posits that central banks and the inflationary tax they enable, also known as seigniorage, are inherently problematic. The book even goes so far as to call them criminal tools for politicians to extract wealth.
It's a strong claim.
It is. And the ultimate solution proposed is pretty radical: the elimination of the central bank. This involves a process including fundamental financial system reforms, like something called Simon's banking, and eventually free currency competition.
With dollarization kind of seen as a practical first step, at least for Argentina.
Exactly. And it's not just about stabilizing prices. Beyond that, the book outlines a comprehensive plan for sweeping structural reforms. The idea is to foster long-term economic growth and prosperity.
So our mission today is really to unpack these arguments. We'll trace the history of monetary thought and policy as the book presents it, try to understand why traditional approaches get critiqued so heavily, and explore the, well, quite radical solutions proposed by Milei and his collaborators, all based on the source material you've shared.
Okay, let's unpack this then and journey through the core arguments of El fin de la inflación. We should probably follow the book's logical progression, starting with the foundational economic theory in the first part.
Yeah, and what's particularly striking right away is how it establishes that central thesis, very much aligning with Milton Friedman. Inflation is purely monetary. It describes it as being driven by an excess supply of money, or maybe a drop in its demand, or, potentially both. The core idea here is that this leads to a loss of purchasing power. It makes all prices, including, say, the dollar, when you look at it through the local currency lens, appear to rise. But as the book explains it, it's really the local currency losing value, like trying to keep a bar of ice from melting in the Sahara is the analogy used.
That's a vivid image. And to really hammer this point home, the book dives straight into Argentina's own monetary history. It's presented as this powerful case study. And what's truly striking is how drastically inflation changed after the Central Bank of Argentina, the BCRA, was created. Before 1935, inflation was, well, remarkably low.
Like almost non-existent, yeah.
Yeah, averaging just 0.9% annually.
Right.
But, as the book notes, after 1935, with this mixed BCRA, it jumped to 6%. And then after nationalization in 1946 and up until the convertibility plan in 91, Argentina averaged a staggering 250% annual inflation.
250%
Annually. The country destroyed 5 different monetary signs, experienced 2 hyperinflations, and all this without being in a war.
It's quite a history. And it's not just ancient history either. Even the convertibility period, from 91 to 2001.
Right, Cavallo's plan.
Exactly. It saw average inflation drop significantly to 9%, though a lot of that was concentrated in the first year and a half, sort of price adjustments. By 1993, Argentina actually had one of the lowest inflation rates in the world. Quite a turnaround.
But as we know, that era ended very badly in a severe crisis in 2001, 2002.
Yeah.
So fast forward to 2022, the book points out Argentina's inflation hitting 100% annually. And it directly attributes this to what it calls a monstrous monetary disequilibrium.
Okay, and what does that mean exactly? Disequilibrium.
Well, the book explains it's due to both supply-side and demand-side problems with money. It specifically highlights issues with past, present, and future monetary emission. For instance, there's this concept it calls the matryoshka of problems with LELIQ. These are central bank liquidity letters.
Ah. Right, like nested dolls, one problem inside another.
Precisely. Yeah. Think of it like rolling debt. The central bank issues these short-term things to soak up excess pesos, but then it has to pay interest on them.
Which often means printing more money.
Exactly.
Yeah.
Creating this compounding cycle that just spirals into massive future emission and, well, the risk of hyperinflation.
And the book links this directly to the human cost.
Oh, absolutely. Dire social consequences. Declining GDP per capita, 40% poverty, 10% indigence, and Argentina having the second lowest dollar salary in the region, only Venezuela being lower at that time.
Wow. Okay, so that brings us to a really fundamental question the book tackles early on. If inflation is purely monetary, where does money even come from? What makes something money? The book gets into this by contrasting it with a barter economy. It explains how barter just doesn't work well because of things like the double coincidence of wants.
Right, I need what you have and you need what I have at the same time.
Exactly. And goods might not be easily divisible. It really limits transactions and cooperation, the solution, an indirect exchange good.
And it gives some interesting examples.
Yeah, fascinating ones, from early money like cattle to salt, which is where the word salario, salary, comes from,
I didn't know that.
to even things like cigarettes in prisons, like Alcatraz, apparently. It uses these to illustrate how an excess supply, like too many cigarettes flooding the prison market, quickly leads to devaluation,
Yeah.
leads to inflation.
So what does this tell us about what properties money should have? The book details 3 key functions. First, it has to be a store of value. It needs to let you transfer consumption from today to the future.
Which is where things like salt or wheat fall down, right? They spoil.
Exactly. It acts like a negative interest rate, or as the book puts it, like melting ice cream. Second, it needs to be a medium of generalized payment, something everyone accepts.
Right.
And third, it must be a unit of account, meaning prices are set in terms of it.
And the argument is the Argentine peso fails on these counts.
Catastrophically, according to the book, especially as a store of value and a full unit of account. Because of the constant inflation, it forces people to use it only for, small, quick transactions. Its only remaining function, the book claims, often ends up being just a medium to pay taxes. And when demand for even that collapses completely, well, that's the road to hyperinflation.
A really critical point the book makes, and maybe a controversial one, is about how the very definition of inflation has changed. Historically, it explains, inflation meant the loss of purchasing power of money. That definition points the finger directly at central banks, at politicians.
Okay.
But the book blames John Maynard Keynes and his general theory for shifting the definition to a general rise in prices.
How does that change things?
Well, it sounds subtle, but the book argues it redirects blame away from monetary policy and government spending. If prices are just generally rising, it sounds more like a market thing, or maybe it's because of businesses or unions or wars or...
Sunspots, even.
Right. Anything but the direct result of printing too much money. It sort of absolves politicians. The book uses this analogy. Imagine a politician choosing between a Keynesian economist who basically validates their spending and a libertarian who points the finger right back at them. It explains why, in the book's view, the wrong theories persist.
That's interesting. And it ties this into the history of economic thought, too, right? It highlights the scholastics of the School of Salamanca back in the 16th century. Apparently, they were among the first to develop the quantitative theory of money.
Yeah, they observed how all the gold flowing in from America caused prices to rise in Spain, and then that spread through Europe.
The specie flow mechanism, David Hume called it later.
That's the one. Foundational stuff for concepts like purchasing power parity, the idea that exchange rates eventually adjust to reflect price differences.
And the book argues Keynesianism kind of distorted this understanding, leading to fallacies like pass-through.
Exactly. The idea that price increases are because the exchange rate jumped, not because of the underlying monetary expansion. The book just says, no, pass-through is simply the flow of excess money finding an outlet.
Okay, and this leads us right into one of the book's most provocative arguments. It frames inflation as a crime.
It really does. It draws on Ludwig von Mises' thinking here, using this powerful analogy about an economy of gold. Imagine, the book says, if someone could magically turn plastic into gold. Producing tons of this fake gold only becomes a crime when you try to spend it, right? Because it debases the real currency and enriches the counterfeiter at everyone else's expense.
Okay, I see where this is going.
The state, through the central bank's monopoly on printing money, is positioned as exactly this falsifier. It uses seigniorage financing its spending by printing money to effectively steal purchasing power from its citizens.
And it mentions this became formalized with forced currency laws.
Yeah, citing Genoa in 1445 as an early example, it's a very stark statement. The book basically presents financing the fiscal deficit by printing money as a crime, like stealing billions from ordinary people.
So based on all this, the book contends that any non-monetary theory of inflation is, and this is their word, a fraud. It argues inflation is impossible in a barter economy because prices are relative. If one goes up, another has to come down.
Right.
And it insists that those other explanations, blaming commodities or labor unions or credit or external shocks, they always require what it calls monetary validation.
Meaning the central bank has to play along by printing more money?
Exactly. Without the central bank increasing the money supply, those price pressures would actually cause GDP to fall. You'd get contraction, not inflation. The problem, the book states very clearly, isn't the initial shock or the wage demand. It's the central bank's choice to convalidate it by printing more money.
And it uses a specific Argentine example here.
Yes, the 2017 BCRA intervention. The book claims political interference led to expectations becoming unanchored, demand for money collapsed, and it shows why inflation targeting models fail when politicians just can't keep their hands off the monetary levers.
Okay, so that lays out the problem and the diagnosis pretty thoroughly. Now, the book shifts gears a bit in the second part, bringing in other economists to talk about solutions, right?
That's right. It offers several perspectives on how to actually end inflation.
First up is Alberto Benegas Lynch, described as a titan of liberty. His argument is, well, pretty radical. Just eliminate the central bank entirely.
No halfway measures there.
None. He argues that central bankers, no matter how smart or well-intentioned, face an impossible choice: expand the money supply, contract it, or keep it the same. Any of those actions, he says, inevitably distorts relative prices,
Leading to.
misallocation of resources, less capital investment, and ultimately lower real wages. He even points out Milton Friedman's own view evolved on this.
Oh, really? How so?
Friedman apparently went from thinking central banks might just make honest mistakes to concluding that money is too important to be left in the hands of central bankers. Benegas Lynch also cites Hayek's denationalization of money.
Advocating for private currencies.
Yeah, privatizing money, letting people choose freely, even if that initially just means everyone flocks to the dollar, like in dollarization. His core point is that inflation is exogenous, political, imposed from outside the market, not something the market generates itself.
Then we hear from Domingo Felipe Cavallo, the former Minister of Economy who actually implemented convertibility. What's his take?
Cavallo stresses that you can't just fix the money problem in isolation. A stable monetary system needs a completely reorganized economy.
Okay, like what?
Things like a clear separation between public and private sectors, major cuts in public spending to get rid of the fiscal deficit, and removing all price controls and state meddling in private markets.
Makes sense.
He argues stabilizing the dollar price is key, especially in places like Argentina, where the dollar is already so present in people's minds and transactions.
And what are his proposed alternatives?
He discusses three main options: convertibility, like the bimonetary system he ran from 91 to 2001, full dollarization, or currency competition, kind of like Peru's model, where the local currency and the dollar compete side by side.
Does he see any obstacles?
He acknowledges a big one. If the country's legal system isn't trusted, it's hard for the financial system to work effectively with the dollar. He suggests maybe using foreign laws or different financial structures, like something called limited banking.
Interesting. Okay, who else contributes?
Federico Sturzenegger, another former BCRA president, provides some historical context. He reminds us central banks were originally created to regulate money and stabilize inflation, an innovation that actually worked pretty well globally.
Just not in Argentina.
Exactly. For him, the absolute key is central bank independence.
And how do you guarantee that, especially given Argentina's history?
He lays out three options: legislate independence, but notes that failed in Argentina because the law got changed later. Second, dollarization. Or third, a common currency, like the euro, or maybe a regional one with Brazil. He personally leans towards a common currency, thinking it's less costly and harder to reverse than just dollarizing unilaterally.
And he credits Milei for
shifting the whole political conversation in Argentina towards these ideas: liberty, central bank independence, making them part of the mainstream debate.
Then there's Diana Mondino, an economist and professor. What's her focus?
Growth. She emphasizes that you can't just solve inflation. You have to do it alongside generating economic growth, something Argentina, she notes, hasn't had in per capita terms for about 15 years.
So what's needed, according to her?
She points to Argentina's fiscal dominance, basically. The government spending needs driving monetary policy. She calls for simultaneous reforms across the board: monetary, fiscal, exchange rate, income policies, all at once.
That sounds complicated.
And potentially disruptive. She cautions that rapid stabilization creates winners and losers and can mess up existing contracts.
What about the LE all IQ debt we talked about earlier?
She tackles that head on. She talks about the financial system being kind of captured by the central bank through things like LALIQ. But she stresses those debts must be paid. Not paying them would harm pensioners and savers whose money is tied up in the system.
So her bottom line is,
The stabilization plan has to avoid interfering with private business and existing contracts, and ultimately pave the way for Argentina to integrate into the global economy competitively.
okay, one more perspective in this section.
Yes, Hector Rubini introduces a more technical but really crucial concept, Simon's banking, also known as the Chicago Plan.
Right, you mentioned that earlier. What is it exactly?
He explains that our current system, fractional reserve banking, has an inherent weakness, a maturity mismatch. Banks take short-term deposits but make long-term loans. This makes them fragile, dependent on public confidence.
And ultimately on central bank bailouts when confidence wavers.
Precisely. Bailouts via rediscounts, which inject money, and guess what? Cause inflation.
So what does Simon's banking propose?
A radical separation. Financial institutions would be split into two types. One, a store of value for demand deposits, like your checking account, which would have to hold 100% reserves. Your money is always there, no risk of bank runs.
Okay, and the other type?
Investment banking for time deposits, like CDs. These would have zero reserve requirements, but the funds would go into things like mutual funds. The investor bears the risk, not the bank and not the taxpayer, through deposit insurance.
So the goal is to eliminate systemic bank runs and the need for deposit insurance.
Exactly. Rubini argues against common criticisms, saying it wouldn't necessarily raise costs or push banking underground or exclude small savers and borrowers.
In his conclusion.
That this kind of reform, plus getting rid of capital controls and doing other structural changes, creates a state that actually respects property rights and doesn't, as he puts it, swindle citizens through bank bailouts funded by inflation.
Right, this takes us neatly into the third part of the book, where Javier Milei himself brings all these ideas together. This is his ultimate proposal: currency competition and dollarization, the end of inflation. And this is also where he tackles the critics head on, right?
Absolutely. The core of Milei's argument here is a multi-stage process. You start with Simon's banking, move to free banking, then encourage free currency competition.
And the final step is eliminating the central bank.
Yes, with dollarization being the most probable first outcome, just given Argentina's history and affinity for the dollar. But underpinning it all is that moral argument again. He insists the central bank is inherently a fraud, that it steals through seigniorage, bringing back that analogy of the gold counterfeiter.
And he reiterates the negative consequences of inflation.
Constantly. Price distortions, forcing everyone to think short-term, punishing saving and investment, misallocating resources, and that regressive redistribution of income, the Hume-Cantillon effect.
What's that again?
Basically, the idea that those who get the newly printed money first benefit, often the government and connected banks, while those who get it last, like wage earners and pensioners, suffer the most as prices rise before their income does. It disproportionately hurts the poor and vulnerable while benefiting politicians.
Okay, so how does he counter the common arguments against dollarization or getting rid of the central bank? The book goes into detail here, like the argument about losing seigniorage revenue.
He dismisses it almost out of hand. He says basically, good, I want to eliminate this theft. Fiscal problems need fiscal solutions, not printing money.
What about losing control over interest rates?
He calls that fatal arrogance. The idea that any committee, however smart, can know the optimal interest rate better than the market itself. He says the market determines the price of money, period.
And losing monetary policy as a tool to manage economic cycles.
His response is twofold. First, many cycles are caused by erratic monetary policy in the first place. Second, markets have tools like futures and options for businesses to manage risk. You don't need a central planner.
What if the economy has rigidities, like in labor markets? Or information problems? Isn't monetary policy needed then?
No, he argues. Those are problems that need structural reforms, fixing the labor market, improving information flows. Using inflation to paper over those cracks is like, his analogy again, amputating a limb just to cure a pain, address the root cause.
And he explicitly differentiates his plan from the 90s convertibility.
Yes, very clearly. He points out convertibility kept the fractional reserve banking system, which made it vulnerable to bank runs. His plan includes Simon's banking with 100% reserves for demand deposits, which he argues eliminates that specific vulnerability.
What about comparisons to Ecuador's dollarization? Critics often point to Ecuador's problems.
He tackles that too. He asserts Ecuador's dollarization was actually a success, so much so that even a hostile president like Rafael Correa couldn't get rid of it. He argues Ecuador's subsequent economic problems stemmed from its fiscal policy overspending, not from dollarization itself. And he points out Ecuador still had relatively high dollar wages compared to, say, Venezuela.
Okay, so after defending the idea, does the book get into the nuts and bolts of how dollarization could actually be implemented?
It does. It moves into the instrumentation, using what's termed a general equilibrium of stocks model,
Yeah.
basically analyzing the balance sheets of everyone involved, the central bank, commercial banks, the public.
And does it suggest Argentina can actually do this financially?
Milei argues yes. He provides figures, acknowledging they change fast, but uses them to show how the central bank's assets, things like government debt owed to the BCRA, international reserves could potentially cover its liabilities, mainly the monetary base, cash and bank reserves, and those LELIQ instruments.
Can you give us a rough sense of the numbers presented?
Well, using an example calculation in the book, he estimates liabilities around $38 billion that need redeeming. But he counts assets like $65 billion in government debt owed to the BCRA, plus international reserves. So even valuing those government bonds conservatively, he argues the assets are sufficient to cover the liabilities needed to dollarize.
What about the LELIQs? Wouldn't converting them cause problems for banks? He argues against the idea this creates a Bonnex plan, right?
Right. A Bonnex plan refers to a past forced bond exchange that hurt savers. He contends that converting LELIQ into more liquid, higher quality, dollar-denominated instruments for the banks would actually reduce systemic risk, making banks safer, not creating a forced default scenario.
So if the math works out, according to him, what's the main obstacle?
Politics. Pure and simple. He concludes the primary barrier is political will because, in his view, politicians benefit from the inflationary tax and are fundamentally unwilling to give up that power.
This brings us to his final vision, his projection for Argentina's future under this plan. He argues dollarization would lead to a strong rebound in dollar wages, a big drop in poverty and indigence, and pretty immediate economic expansion.
But it's not just about dollarization, is it? It's tied to broader reforms.
Absolutely critical point. He stresses this monetary reform has to be coupled with 3 generations of structural reforms. The first generation sounds pretty intense: drastically shrink the state, cut ministries, slash public spending and taxes, eliminate regulations, major labor reform moving towards unemployment insurance, and opening the economy wide up.
And he thinks that alone would generate significant growth.
The book projects 15 years of strong growth just from that first wave. Then comes the second generation, reforming the pension system, offering voluntary retirement for public sector workers, phasing out welfare programs as jobs grow.
And the third generation?
Tackled major reforms in health, security, and education, plus reforming how tax revenue is shared between federal and provincial governments to better align spending responsibility with revenue collection.
So it's a long-term vision.
Very much so. He claims this comprehensive path could turn Argentina into one of the world's richest countries in maybe 35, 40 years. And interestingly, he suggests 2/3 of the improvement would happen in the first third of that time.
A bold claim.
Definitely. And his final message in the book is really a rallying cry for freedom. It's positioned against what he calls the criminal organization of the state, singling out the central bank as the most nefarious and socialist instrument in any economy. Well, we've certainly taken a deep dive into el fin de la inflación. We've explored its core arguments. Inflation is purely monetary, as a theft by the state via the central bank, and the proposed radical solution of dollarization underpinned by deep structural reforms as the path forward.
Yeah, and it really leaves you, the listener, with a fundamental question, doesn't it? Given the kind of history presented and the economic theories laid out in this book, do you think the answer to persistent inflation really lies in such a radical restructuring of monetary institutions, or is it more about finding ways to reform the ones we already have?
It's interesting how the book frames it not just economically, but morally. It really questions the fundamental role of the state in our financial lives. It's definitely a lot to chew on, and it challenges many conventional ideas about economic management.
Absolutely. Understanding the nuances here, how money actually functions, its history, the real-world implications of different monetary systems, all laid out so meticulously in this work, it really can change how you think about economic stability and even your own prosperity. It underscores that something seemingly simple like inflation actually has incredibly deep roots and complex consequences. And according to this book, at least, it demands equally bold and comprehensive solutions.
Indeed. Until next time, keep seeking those aha moments, and remember, becoming well-informed is your shortcut to a deeper understanding of the world around you.